What do you do when financial chaos strikes and things start to look rough? Traders often turn to trusty options like gold and the US dollar. Gold and the classic USD are like the superheroes of safe assets, joining forces with US bonds and the Japanese yen. Now, in 2020, gold prices didn't just hit $2,000 once or twice, it happened 3 times. Thanks to the pandemic and some regional bank drama, the gold market was buzzing like crazy. Then, there's the good old and reliable US dollar, especially when the economy is doing good and interest rates are on the upswing. So, should you buy US dollars or gold? Let's break it down. First, let's unravel the connection between gold and the US dollar, shall we? Throughout history, gold has usually danced in the opposite direction to the USD. Both of these assets, though, share the limelight as go-to choices when uncertainty knocks on the market's door. When the stock market gets a bit wild or global fears spark up due to geopolitical events, investors and traders often shuffle their money into what they consider safer or less risky options. That's where USD, JPY, US bonds, and our golden friend gold step into the scene, earning the title of risk-off assets. This is thanks to the perceived stability and longevity of the underlying country or value. Now, here's where it gets interesting. Different scenarios of risk-off environments tend to nudge investors towards gold or the USD. Gold, with its shiny allure, becomes the star when unexpected events like the wild ride of the COVID pandemic in 2020 or regional US bank mishaps in recent years strike fear into the hearts of traders. In these instances, gold prices soared, hitting the $2,000 mark 3 times. But when gold troubles and geopolitical tensions take center stage, traders often turn their gaze to the US dollar. Unlike gold, the USD's demand spikes due to its relative strength. The dollar likes to flex its muscles when economic conditions take a dip elsewhere, enjoying stability and higher interest rates compared to its global counterparts. So, whether you're a market enthusiast or just trying to decode the financial puzzle, understanding the intricate dance between gold and the US dollar could be the key to making savvy investment moves. You might have come across articles and folks saying gold is the shield against inflation, claiming the dollar lost its shine compared to gold. But starting with the most straightforward scenario, rewind 100 years. So, if you'd had $100 back about a century ago, you could either stash it under your mattress or go all in on gold at $20 an ounce. That $100 would buy you 5 ounces of gold. But if you have a $100 bill, you still got $100. But if you choose gold with the current price at $2,000 an ounce, those 5 ounces turn into a cool $110,000 when you sell. That's the deal when people talk about dollars versus gold and the whole inflation hedge thing. It's like having either $100 or $10,000 in your pocket, and gold takes the trophy. Simple, right? But you're probably wondering about gold versus cash with the savings rate, and there are indeed different angles to explore when it comes to opportunity cost. So, let's dive into that $100. Instead of tucking it away under your mattress, imagine putting it to work in a savings account with a sweet interest rate. Now, there will be interest rates dancing all over the place during that period. Let's keep things easy. Say it's around 4% each year. Your $100 would be compounding at 4% annually, and after a century, you'd be looking at $5,424. Not too shabby, right? Now, compare that to gold, still standing strong at $110,000. Gold takes the crown, but hey, it's still more complicated than that. What if you consider savings rate and taxes before you buy dollars or gold? Taxes can be a bit confusing, right? So, imagine you throw your $100 into the savings ring, hustling at a cool 4% interest. But here's the twist. Taxes join the party, dancing between ups and downs. Let's keep it simple and say they average around 25% annually. The bank tells you how much interest you've earned, you toss it onto your tax form and pay your 25% dues. Crunch the numbers with a trusty calculator, and after this tax tango, your $100 turns into $1,981. Let's round that up to a clean $2,000. Now, let's peek at gold. It's a bit different. You can't put it to work like cash. So after our 100-year imaginary journey, your gold is chilling at a sweet $10,000. Hold up, taxes? Here's the twist. Gold's rising, but you're not earning a return, which means no taxes. So you're sitting pretty with a sweet $2,000 from your taxed $100, while gold is rocking a solid $10,000. But there's more. If you decide to cash in that gold and turn it into $110,000, taxes once a piece. The long-term capital gains rate struts in at 20%, taking a $2,000 cut, leaving you with $8,000. Even without the VIP treatment, if you pay 28% federal taxes, you'll still end up with $792. Compare that to the $2,000. Gold's still shining bright. It's like a financial showdown, and gold, my friend, is the reigning champion. So there you have it, $2,000 versus $8,000, and gold takes the crown. Now, let's chat about keeping gold with zero taxes, especially if you're eyeing it as an inheritance move. Okay, so you've got those 5 ounces of gold just chilling, no bills to pay, no urgent need for cash. Fast forward to the inevitable, and you decide to pass on this golden legacy to your heirs. Here's the thing, if they sell that gold, their tax story starts in the same way. But if you sold the gold before the handover, your starting point for taxes would be the $100 you initially paid. Sell it for $10,000 and you're looking at $99,900 as your taxable gain. But in the world of inheritance, things take a different turn. The gold starting value for your heirs isn't the $100 base. It's the fair market value when they received it, let's say a solid $10,000. So here's the sweet deal. They don't pay taxes until they decide to cash in on that golden treasure. The gold's value to them is that fair market value, $10,000. Forget the taxed $99,900 gap. Their difference is a smooth $10,000. If they decide to sell it for $10,000, no gains, no taxes. The magic lies in their starting point, the fair market value when they got their hands on that glittering gold. Keeping gold forever, passing it along, is like a tax-free legacy. Sure, if its value spikes over time, it may face some taxes when it sells, but it's a small price for the golden journey. This simple strategy is why they say gold is an inflation hedge, and personally, it's why you should be all about diversification. Whether it's crypto, gold, bonds, or just a stash with cash earning interest, diversifying is key. Investing in gold comes with a lot of advantages. First off, it acts like a shield against the sneaky inflation monster. When inflation creeps in and makes the dollar lose its power, your cash loses its mojo. But gold just holds the same value when inflation knocks on the door. It's not a guaranteed win, but hey, it's worth having on your portfolio. Secondly, gold can be a reliable companion during economic uncertainties. When the financial world gets shaky, gold tends to shine a bit brighter. It's not a guaranteed strategy, but it might offer some stability during unpredictable times. Lastly, diversification is a key strategy for smart investors. Instead of putting all your money in one place, adding some gold to your investments can be like assembling a well-rounded team. This mix helps you navigate the ups and downs of the financial journey. Just keep in mind that the right balance depends on factors like your risk tolerance and financial goals. If this financial face-off has left you intrigued, don't forget to hit that like button and subscribe for more insightful content. Have any burning questions or specific topics you want us to delve into? Drop them in the comments below and let's keep this conversation going.